Welcome to the Financial Advocacy Podcast. I'm your host, David Kinder, the tax-exempt wealth guy, registered financial consultant, and charter life underwriter, and my co-hosts, Michael Moffat and Kurt Gibbs. This is a disclosure where we say you can't hold us accountable for any actions you take on your own, just like all financial entertainment shows. We are not providing legal, tax, or securities investment advice of any kind. We do provide general investment information for educational purposes only, and we will discuss alternative financial strategies that do not contain or include securities. You can view all of our disclosures and disclaimers at our website at www.financialadvocacypodcast.com. Look both ways before crossing the street. Let's get started. All right, everybody, welcome back to another episode of Financial Advocacy Podcast. We're all here today, and we are 2 weeks out from the end of the year, which is full of illness and sickness and changing weather patterns. And of course, the topic of the day is tax planning, year-end tax planning. And here's the best part about this topic. I didn't have to prepare a single thing. I've got almost no notes. I went over a little bit of this with Kurt right before he came on here, Mike. I've got only one question to ask, and we'll do it later on. But I am happy that I didn't have to do a whole lot. Let's be focused on some other things. But we're going to bring some great content because we're bringing back your friend of mine, Brian Sommerfield. Let's bring him back on the stage here. And Brian, welcome back. Really glad to have you. We're really excited about this topic because we went through a couple of checklists a couple of weeks ago on some year-end planning things, which was overall financial planning and some tax planning kinds of things. Mm-hmm. But this is the time of year where, obviously, other than holiday planning and family relationships planning, and, you know, people getting sick. I got sick last week. I'm still feeling a little bit. At least it's not COVID, thank goodness. But, you know, all those things going on. This is the best time of year to start taking a look at things. What can we take advantage of, especially for the last 2 weeks of the year? You've got a bunch of notes that I'm hoping that we're going to be able to have some roundtable discussion with.
I do. I came prepared.
Awesome. That means you understood the assignment. I love that. So we're going to let you take it away. And the main question, there's only one question that I would have that may or may not be for your notes. I was on a tax planning webinar just yesterday morning. And of course, they're trying to sell financial advisors on their course. They made a certain claim. It was interesting. They said there's 171 different tax deductions available, particularly for self-employed people. And he says most of them only claim like 24. And okay, so I'm wondering if, in your experience, are there a number of deductions and credits that are out there that are misunderstood and therefore underclaimed and underutilized that we should pay more attention to, that we could really use to enhance our taxes, our tax filings and such? So I'd be curious what your thoughts are. I did take some notes from this guy. That doesn't mean I'm going to...
Let me use a technical term for that. Balderdash.
Okay.
I mean, let's make this really simple. And as a matter of fact, I'll even tell you a good story that will just kind of lock it in place for you.
All right.
Your income is simple. What revenue do you have? Either you're an accrual basis or cash basis. Not too hard there to figure out what your income is. Your expenses is any expense used to generate that revenue. Now we're all fine young or gentlemen here, at least on the younger side of life, especially where I live at. I'm considered, you know, like a like a little kid.
Yes, your gray hair is barely showing up. Yeah, and I've got some too, and even Kurt. I think Kurt, you're just a little bit younger than Brian, I think, but just a hair.
Well, I'm in Naples, Florida, which is kind of like the last resort for Americans. It's the waiting room of death, or America's nursing home, however you want to put it. So there was a tax case, and again, we're all fine gentlemen. I'm sure none of us ever experienced this. And there was a exotic dancer by the name of Dixie Bubbles, and Dixie filed her taxes and got audited because some of the expenses weren't quite right. And it went to tax court. And Dixie tried to write off some expenses that the IRS claimed were only medical. You know, those are medical expenses. You can't write those off on the business. And her and her lawyer countered that breast augmentation surgery is not always medical. Sometimes, depending on how you write it off and how it applies, I wrote them off as stage props. And the IRS says, oh, those could never be stage props. And she says, au contraire, Mr. IRS and judge. Here's what we're going to do. This was my income. There, right there. This was my income before stage props. This is my income after stage props. Any expense used to generate revenue, and there's a clear correlation between revenue generation and the expense, is deductible. I rest my case. Guess what? Dixie Bubbles proved two things. One,
that's funny.
You can win against the IRS if you are well prepared. And two, men are pigs.
All of which we already know. Yes. Okay.
So there is your case that you could always put in the back of your mind and go, you know what? Is this deductible or not deductible? And is there 29 lines? Is there 150 lines? It's going to be dependent on what kind of business you are in. So if it is an expense that is justified against raising revenue, yes, deductible. If it's not, the answer is no. And it can be different based on the type of business you're in, maybe the type of area you're in, how well it relates to what you did to generate revenue. It's all that. That's why it's not just a yes or no profession. It depends. There, does that answer your first question?
That's part of it. But
Wow.
Oh, I can't wait till you aggregate this and put this in a short. This one's going to be good. I can already see those wheels spinning on that.
Well, I think there's going to have to be a difference between, and we're going to go down this rabbit hole for a second here. There's got to be a difference between an exotic dancer and a sugar baby, because one might be more of a hobby, and the other one and lifestyle, where the other one is clearly a business expense where you can identify the source of income.
No, that's a great point, because again, I have no idea what the terms were that you were using, but you know, there truly is something between cosmetic and something that is needed because of actual medical procedure and revenue generation. So it just you better whatever you do can justify whatever you claim and how you do it.
Okay.
And that's the reason why they only give you so many lines with actual words in them, and then a whole bunch of lines that are just blank that you fill in what the real category is.
Okay, so for all the OnlyFans ladies that are watching this, there you go. What else can I say? They're not our target demographic, but there we go. I do know someone who did have them as their target demographic, and that was an interesting business choice for them. So anyway, what?
If
yeah, so what?
And here's where I think that you're wrong where it should be a demographic, because if you've got a business and you're a small business owner and you're generating a lot of revenue without a lot of expenses, who should you be looking at to make sure that you can maximize that window of opportunity and have that money around for the long time or get the most benefit out of it? I would think somebody like the financial practice of Moffitt, Gibbs, and Kinder, GK Financial, would be what they were looking for.
Well, the main people that seem to look for and fight with the IRS for every single dime, nickel, and penny that they earn are business owners, no matter how you go about doing it. And of course, now these days, we've got more of the influencer type of business owners that are coming more on the scene, which includes those that have membership sites of whatever they are. Mm-hmm. And, social media, like I've got obviously YouTube, it pays me not that much, but it does pay me. I'll take the money. I'm not going to send it back. Facebook has payment plans. TikTok, there's all kinds of ways to get paid on social media. So that's a new kind of entrepreneur that doesn't necessarily have an office building and a door on it for you to walk
I
in
do
and
have
knock.
clients that are involved in social media. No OnlyFans or anything like that, but actual social media, that is their business, and I have them as clients. So no, I think it's a great market to target because a lot of times, when you think about it, a lot of times these are younger people. They need guidance not only in taxes, financial, but business. You can offer everything to them. So no, I think it's a great market because what's the number one thing that business owners need, whether you're an online business or you're brick and mortar? It's cash flow. Cash flow, cash flow, cash flow. How do you manage cash flow? How do you make sure you have it around to meet demands and growth or anything else that happens? I mean, I'll give you the biggest example as far as why businesses need to have access to cash and cash flow. What would happen if the business came along and said, we're going to have to shut your business down for a minimum of 3 weeks. I know this is kind of last minute. Hey, hope everything's okay. See you in 3 weeks. Oh, the government would never do that, COVID.
Yeah.
But, they could. COVID.
Yeah. They've already done it once. And now that they've done it once, it's going to be that much easier for them to do it again for whatever other reason that happens to come along. What do we call it back? I think we called it business interruption coverage. Not the literal thing, because there's property and casualty types of coverage for that. But we're talking about just making sure you've got enough credit and cash flow available to keep your business afloat during such events like this that will eventually happen again, because they've already done it once. All you got to do is pull the trigger again, probably for something even less drastic now, because now we've been conditioned, we've been trained. Okay, so what else can we do? We got 2 weeks. That was
your first question. I don't know if it really hit year-end planning, but I hope it did. So here's the big one, and this should be automatic for anybody that has investment money. And that is, if you are over 73, your required minimum distribution. It happens where all of a sudden it gets missed and it becomes a major tax problem. And here's where it could happen. If, let's say, you did a 1035 exchange on a annuity, it's qualified money. Most of us wouldn't put qualified into tax deferred, but it happens, and it's not the end of the world. But a lot of times in a situation where there's a rollover or a CD that you renewed, there are times where sometimes it's not all with one company for the whole year and it gets missed. I'm giving you examples of where it would be missed. And it does happen. Unfortunately, I've had to walk clients through it on the tax side, and it's not pretty. But if you don't need the RMDs to pay for your living expenses, you have some options. And this is an option that I absolutely love, and it's called a qualified charitable distribution. Why is this good? If you're over 70 and a half, and you can do up to 100,000 of this a year. And let's say you, one, you don't need the income, or two, you don't have enough expenses to itemize the deduction on your tax return. Well, if, let's say you're taking the RMD, it has to go on your tax return. You have to pay taxes on it. You donate it to charity. You don't have the ability to itemize deductions because your standard's higher. Well, guess what? A qualified charitable distribution can go straight from the fund company to the charity. It does not become income on your tax return. You are not able to deduct it on your tax return. So guess what? The company that received the money, the charity, gets 100% of it. You meet your RMD requirement at the fund company. It's a win-win across the board. Now, if let's say you don't want the money to hop on your tax return to maybe make your Social Security more taxable or something like that, now you're able to do that as well. So this was something that they tucked into the tax code a couple years ago. I do not see this come across very much at all. And it's the qualified charitable distribution.
Yeah, no, there's some neat opportunities with that one. And I think the key is that you have it directly distributed from the fund company or Nudicate, wherever those qualified dollars are at. It has to
You
go
never touch
direct
it.
to them. So it cannot be paid to you, because otherwise then it becomes a taxable distribution to you. And then you're making a charitable contribution. But
Exactly.
then in order to deduct it, it still has to be included. Does it surpass your standard deduction or not?
Yep.
And if it doesn't, you kind of wash it out.
You eliminate the middleman, you, in this transaction. So it goes straight from fund company to charity. You still get the 1099. You still have income on box one, but you're able to just flush it out through that code on your tax return, so that as if it never touches your tax return for tax purposes.
There we go. So that's a way that even people with modest means, if they're not needing that RMD, that's another way that they can take a legal advantage of that. I just noticed how I said that.
Yeah.
But yeah, so that could bypass your entire tax return. I like that.
No, this one hits a lot of people. This one fits all over the board. That one's a really good one that not a lot of people talk about.
Now, but for meeting the RMD, though, it only meets the RMD requirement for those funds, because I think you're carving out that particular account for that RMD.
But your RMD is based on your total qualified, not that individual account. So you could meet it from one account. Same way if let's say you had let's say you had 4 different qualified funds. You've got your fund that's just doing incredibly well, and let's say you've got one that's just, it's so bad. You just even hate to look at the statement every time it comes in. And when the advisor calls, it goes straight to voicemail. Matter of fact, you've probably even created a code inside your phone to just, I don't want to talk, put it straight to voicemail. So you're not going to want to sell your really good performing stock in that one qualified plan, but you could pull all of the required minimum distribution. You can aggregate them, see what the total would be on the aggregate, and then pull it all out of the dog.
Yeah, wherever you want to pull it from, as long as it's met from at least one account somewhere, as long as the entire amount has been done, that works. And of course, you could probably split it between, I want half of that as income to me, the other half is a charitable distribution, whatever you want to do.
Yeah, however you wanted to do it. Yeah. And you could do it that way as well. Yeah. So here's one, and this is one I'm kind of interesting to see how Mike chimes in on this one, because we've had a lot of conversation, have worked with this in the past, and that is the Roth IRA conversion. Now, I'm not going to go where most clients would do this and talk about it. Normally what happens, you have people that they make too much money to really go into a Roth, so they put it in a traditional and then do a backdoor conversion and all that. Here's the group that I'm talking to. And this is business owners. And here's why I'm talking about it with business owners. Sometimes business owners, depend on the industry that you're in, can have income cycles that are higher or lower. A couple years ago, real estate agents did really well. All of a sudden, mortgage rates went up, their income went down. And that happens in cycles all the time in a lot of different industries. It's just easy to see in the real estate market. Let's say you're in during some really good years, you tucked money away into qualified money. Let's say you made too much to put money into a Roth. Well, guess what? If you've got a really bad year, or even let's say you have a flow through entity and you've got just negative money, or a business with negative, when would be a great time to show money on your tax return? Now would be the time to convert that qualified money. And I would convert it all the way up into the edge of the 22% tax bracket. Get your business up to zero, take your full deductions, 10 and 12% tax bracket, max it out as much as you possibly can. That's a good thing. So sometimes Roth conversions, even though all of us here, and I'm sure normal people that would listen to this would realize what a super Roth is. We would rather deal with the super Roth, but under these conditions, if you already suckered into doing qualified money, this would be a pretty good way of trying to get it out.
Yeah, and it doesn't necessarily mean you have to make ongoing year by year commitments either, because that's one advantage of a Roth. A Roth, you could just do it once and you let the account do what it's going to do. And that's one advantage there compared to the super Roth, or what we call the original Roth. And since I already have it here, I will bring up my definition that a Roth IRA is a stripped down government regulated benefit reduced imitation of cash value life insurance to help banks and brokerages offer accounts with somewhat similar tax benefits. So yeah, that wasn't prepared in advance, but there it is.
And all of us here hate imitation, and it's no reflection of the first story we talked about at the beginning of this podcast.
Oh boy.
We like the real thing.
That's right.
Original Coke. Original everything.
Let's clarify that. Original Coca-Cola.
We're talking about when it was in the glass bottles in the 70s.
They don't remember that, Brian. They don't remember
it wasn't in liters either. It was in ounces.
That's probably more similar to Mexican Coke now, because they still use cane sugar.
Correct.
All right, but yeah, you have a tax offsets when you have a net operating loss to offset with other things to be able to take advantage of that. That is one great way to take advantage of some tax planning for the calendar year, especially since now you probably know where the business is at for the year. So might as well take advantage of that. And we talked about this a couple of weeks ago. It's something similar to when if you're recapitalizing on a reverse mortgage and you're paying that mortgage interest, you've got an eligible deduction. You might as well do a IRA conversion, or take some money out of that IRA and offset that, and be able to take advantage of it. It's a similar concept that way. So there's other things that, depending on the kind of year you've had, take advantage of those things to net out that tax bill and take advantage of taking something that would be forever taxable and turn into never taxed. All right, what else you got?
Boy, you're pushy today.
Very, very demanding, huh?
Yeah, for someone with one question.
How many questions you guys bring today?
They're just waiting and see if I already answer it through the list.
We're in the queue.
Here's more of something just informational. This won't hit a lot of people, but it's just good to know. The annual gift tax exclusion amount will increase from $18,000 this year to $19,000 in 2025. And again, if you're husband and wife, each of you can give that. And a lot of times where I see this come into play, and this is good to factor in at the end of the year. Remember, if let's say you wanted to give some money to your child and their spouse for, let's say, a down payment of a house so that they don't have PMI. Well, you're in December, you could technically give them the maximum amount, both husband and wife, in December, and then turn right around January 1st and do it again. So we're at a time at the end of the year where you can capitalize on everybody being a calendar year taxpayer. Whatever happens January 1st through December 31st gets locked into that year. And just like a good stopwatch, you click it, clear it, and it starts all over again January 1st. So I bring that up because a lot of times people are like, hey, I'd like to give more. This keeps you from having to fill out extra paperwork, get twice as much to where you want to go and make it all work. So I tried to come up with some different ones that you normally wouldn't hear from most of the pundits out there. Then the next one is one that you probably hear quite a bit. but it's good information. I threw it in there because I like it. And that's, making sure if, let's say you work somewhere and you have different things like either HSAs, or maybe you do your child care through a tax benefit program where you can only do so much. This gives you a time of the year where you can make sure you've either used it all. If, let's say, you don't use all the benefits for your child care, that's just going to flow over and become income to you if you don't use it all. So, make sure that maybe you can prepay some of your expenses or whatever you need to do to make sure that you use it all. If let's say you are anticipating some extra expenses, medical wise, maybe you're trying to get some stuff done before the end of the year, or you haven't maxed it out, whatever you need to do, look at those types of tax benefit kinds of programs that you've built in through your employer. Make sure you reconcile your expenses with what you've tucked away. And if you have a need to put more in to get the tax advantage, let's face it, medical expense, it's like, oh, your medical expenses are deductible. That's a tax deductible item. It is, but not many people are able to take that as a deduction. Not many people are going to meet 7.5% medical expense of their adjusted gross income.
Right.
So these HSAs came along to help get a tax advantage through your employer or through the plan. If, let's say, if you're self-employed and have one set up, you can do that in a way to at least get those expenses tax deductible, or where you'd never be able to get it done through your Schedule A or through normal tax planning.
And and that's bringing to mind the FSA, flexible spending accounts, which if you don't use it by year end, I think you lose it. So, and that's money that's normally taken out of your paycheck every month. So if you don't use it and you lose it, use it. And you can prepay a bunch of stuff. Go on Amazon, find anything that's FSA eligible, and just, stock up. I'm sure there's plenty of stuff like that could be done. Okay, no, great, good tips.
Here's one that I think most people just don't have a clue about. And if you really want to understand taxes and understand the game, step one is to know what tax brackets are and how they affect you. I mentioned earlier when we looked at some of the planning is, take this all the way up to the top of the 12% tax bracket. Well, if you take your standard deduction plus the amount of the 12 up to the 12% tax bracket, depending on what you're in, whether you're single, married filing joint, married filing, whatever it is, know what it is for your classification, because that gives you the lowest possible tax threshold to either stay around or plan in. Or if you're up into the 22%, how do you make sure you don't get into something higher than that if you could get it lower? And here's why I say know where some of those things are. Because if, let's say, you just bump into the 22% tax bracket, you have an opportunity and you itemized. Do you want to possibly maybe give a little bit more to charity this year? Let's say you planned on doing it, or you're part of a systematic giving. Maybe instead of giving it into January, you just put it into December to get everything below that certain bracket. Or property taxes. Again, in the bracket where property taxes are, it's under the heading of all taxes. If you're in a high property tax area like myself, you might not want to make sure you pay 2 tax bills in 1 year, because that's limited to $10,000 max per year. That was changed a few years ago. So you make sure you don't pay 2 years. Maybe you paid one late and you're like, I normally pay it by December 31st, but you paid your last year's one late. Now you've got 2 in 1 year. You lose the deduction. So those are all types of things. Timing of your Schedule A deductions and knowing what your tax bracket is are 2 easy things that you could do as just part of your normal tax planning. And if you don't know how to do that, that's a real easy question. And most accountants would just explain it to you and say, I wouldn't even charge you for it. It's just, here, let's make sure that you understand this. And here's my philosophy as a tax preparer. I treat tax season like the harvest. I treat the rest of the year like pruning, fertilizing, all of that. I'm like the gardener. I'm like the person that wants to make sure that when it comes harvest time, there's a good harvest. The last thing I want to do during tax season is tell somebody, why did you do this? If you would have just made a phone call, we could have done all this planning for you and you would have been in a better situation. I would have had a happier client. So most of the time, most accountants should want to explain this to you and help you understand it, especially if it's a planning opportunity, so that you're going to be happier, so that you are going to have the best, lowest possible tax liability based on your situation. And that's really what you want to accomplish. And again, I say that under the heading of lowest possible tax liability, not just in a single year, but also your lifetime tax obligation, which is where we start looking at too. Does qualified plans really help you out or not? Are you going for the deduction or are you going for wealth? So that's what I have.
There, yeah.
Which brings up a question I have for you, Brian, and you really almost started touching on it there, but without going into the weeds with it, let's just scenario that you've got a business owner. Here we are, 2 weeks left in the year, and they've had a really good year. What can a business owner do at this point to? I mean, do they need to spend money to save money, so to speak?
I'm glad you brought that up because I get that question a lot. And I put them into two categories. We are not in a situation where tax rates are punitive. And I say that because if tax rates were punitive, and let's say for every dollar you spent, you got it back in tax savings, it'd be like, okay, I'm going to buy that equipment because it's not costing me anything. Or you hear the comment, well, the only reason they bought that is because they got a tax deduction. Rich people do not operate like that. Why would you spend $1 to get 22 cents back? That there's fuzzy math, to quote a former president. They don't do that. So that's why I say put them in two categories. If you're just spending money to try to lower your tax, return, no, that's not a good way. But if you're going to make the expense anyways, and again, where your tax bracket threshold is, and that if you had, let's say you're looking at buying a piece of equipment, you're going to buy it sometime maybe in Q1, and it benefits you by buying it in the fourth quarter, you just accelerate that expense so that you could take advantage of it a year early based on where you're at as far as a good year, bad year, where the tax bracket is and all that stuff. So that's how I would treat it.
So basically you want to treat it where you're buying things that you actually need and use versus things that you would want or that are kind of more like toys.
Never justify an expense just because, I'm getting it as a tax write-off. That's correct.
So let's have fun talking about the gross vehicle weight thing. Because if you buy a car that is over 6,000 pounds, not 6,000, it has to be 6,001 pounds and more, that apparently you could deduct the whole thing as long as over half of it is used for business. So we're talking Rolls Royce, we're talking, Bentleys, Range Rovers, and it can be new or used. I don't know. I guess it might be a wash. Depends on how it's being used and deployed in a person's business. But some people, if it can actually accelerate their business, go for it. But I don't know, I think of like Grant Cardone. He buys a jet. Now the thing's like $60 million. I think he gets a full deduction. I don't know. But if as long as you're using it for business, and you were planning to do so anyway.
As long as it is one of those things where you can justify it based on tying it to revenue, which I'm sure he'll be able to.
Oh yeah.
Again, for most small business owners, they're going to get a better deduction and not have to worry about depreciation recapture and not worry about different insurance or encumbering their business and everything else by just buying whatever vehicle they would normally buy and take the standard mileage rate. That's going to be your easiest,
Yeah.
cleanest, simplest for 90% of the time. Now, if it truly is a bigger business and you have a fleet, you don't have a choice. You're going to depreciate them, or you're a pickup truck contractor and your name's on the side of it. You're a corporation. You're going to put it in the business and drive it 100% for business use. It's probably going to be inside the business. For most, it's going to be just keep a standard mileage rate. Don't make any unnecessary expenses just to try to get the write-off. You're going to be further ahead keeping your cash and paying the low tax rate that we're currently in under current tax law. Down the road, if that changes, different story. But under current tax code, I think that's still the best way to do it. Again, everybody's individual situation is different. All you need to do is run the numbers on your situation and know exactly where you're going to be at.
So don't let the tax code wag the dog.
Exactly. That is a very good way to put it.
Yeah. So if you're doing it just for the tax code, that's not going to work. But if you had other plans, maximize the tax code to your plans, whatever you're planning to do. So
exactly.
Okay.
Yep.
Gee, we just summarized that real quick.
Brian, what about for the individual or the W-2 worker that it's the end of the year, and I see this a lot in my area with and it's across the country, but you have a lot of people that want to retire at the end of the year, end of the calendar year, for instance, and they're going into retirement, January 1, and they're single or married, filing jointly, whatever it is, and Social Security, they're going to be taking that option just as soon as it's available. What can the retiree that's just going into retirement, what kind of tax planning do you not so much recommend, but what kind of planning do you need to start doing in January for those folks?
Well, what's interesting is that both David H. Kinder, RFC, CHFC, CLU,
and you forgot BFD,
and Brian Sommerfield have the same exact thing that says, you should call me if. The third one down is you retire or consider retiring. And there are transition phases in life that truly need special tax planning. When you get married, what I like to call the first marital spat is when you do your first tax return together, because you take two individuals that have always had how they've done things, and all of a sudden it doesn't work that way anymore because there's two incomes, and the way the IRS has screwed up how W-4s work no longer work the way that they should work. The IRS simplified it. That should tell you something. They made it impossible for people to figure out. I think, Reagan probably, put it best, we're the government and we're here to help.
I know you and I have
They're not helping.
Well, let's clarify. Reagan said those were the 9 most terrifying words being spoken by government. So he didn't say that. He showed the example.
He definitely insinuated it.
No,
it's celebrity voice impersonator.
I was just gonna say, Brian, you and I have been on meeting in person and on webs and other things together, and you even said yourself that if the IRS really wanted to, they could make the tax returns like 2 or 3 lines or something like that and make it very, very simple. But here we are with a possible 170 deductions or whatever.
Yeah. And it's never been about, it's never been about revenue generation for them. You take a look at how the tax code has evolved, and most of the tax code is evolved around social engineering. And you think about how much of the tax code revolves around that, and you're like, wow, man, this is sad news. I hate this. And there have been times where I've really had to separate myself from the code, because you look at it and you're like, man, this is depressing. But you have a job to do, and you try to use it to help people the best you possibly can. And kind of like the way Hawkeye was in MASH. Hawkeye had a battle against death every time he walked into the operating room, and he treated it as a game, and he was going to win. And at a young age, I determined that that's how I was going to treat taxes. So, when you really look at how the code is put together and you start seeing all the social engineering in it, it's depressing because it's no longer about revenue generation. And when you realize that the government doesn't have a revenue problem, they have a spending problem. And that's why when I see something like what Elon Musk is doing with Doge and things like that, that's something that everybody has wanted to have done for a long time. And maybe now we're finally going to see it. And in part of that simplification could be the tax code. Let's hope that it is.
Well, we'll find out soon enough, I think. But the tax code. I read this from what Robert Kiyosaki, Rich Dad Poor Dad, and basically he says that the tax code it incentivizes certain behavior patterns, and then it penalizes you for other behavior patterns. Basically, if you want the rewards of the tax system, you got to figure out what the rewards are, so you can maximize that for your own gain. You can figure out what the agenda is of the government for you, but you don't have to. You just need to know what is it, and does it make sense for you.
And I remember I had this older couple that came in to my office, and they sat down, and they were almost kind of a little embarrassed, and were both widowers, and they sat down and said, "We're thinking about getting married, but the one thing we don't want to do is we don't want it to affect our taxes." And I looked at him, I said, "You probably just shouldn't get married," because at the time there was a marriage penalty. And in part of me, I turned my business card over and basically said, "You know what?" I said, "This is more of like a counseling session than taxes or anything. But if you're truly looking to get married and taxes is a concern, you probably shouldn't get married anyways. Just continue to do what you're doing." And that has changed. The government realized that having a marriage penalty probably wasn't sending the right message, and they eliminated that a number of years ago. So that's no longer an issue, but for a long time it was. So you ready for some financial year-end checklist stuff that are my golden 4 or 5?
Let's do it. Yeah, let's go.
Okay.
This is bonus content time. Bonus content time for the Financial Advocacy Podcast. Here we go. Number 1, review your beneficiaries. You don't want your third ex-wife to still be on your life insurance policy or your 401k or anything else. And how many times do you read stories in financial publications to where somebody left all of this money to the wrong person?
Yeah, we actually kind of touched on this. What was it, Kinder, last week?
Or 2 weeks ago. Yeah,
2 weeks
either one.
ago?
Yeah.
Yeah.
So that's number 1. Here's number 2. Our situations change all the time as far as need, income, all that stuff. A lot of times people get life insurance and it's planned for the right way. If any of these 4 things change, you probably need to change the amount of total death benefit. Has your debt increased or decreased? Has your income changed? What about your mortgage? Do you have more kids and you want to account for education added into that thing? So debt, income, mortgage, education, dime. If any of those things change significantly, you probably need to change the death benefit associated with what your death benefit would be for the family or the obligation. Does that make sense? Death benefit isn't just to set it and forget it. That is a moving target. And your year-end planning is a time to sit down and go, do I have enough? You have another kid. guess what? You're probably going to need more income. You have a spouse now that's now staying at home, probably needs to change. You got more coverage that needs now to fit that environment. Maybe you got a larger home. You moved. You're going up the social ladder. You probably need more death benefit.
Yeah, I'd rarely reduce it, but definitely review to make sure you have enough coverage to cover what your needs, goals, and obligations are.
Well,
Yeah.
no, I could see where the time would be to reduce it in this situation.
Sure.
This is a planning situation. Let's say you had 2 million of death benefit and you had it on convertible term and you were getting closer to the end of the term and you no longer needed that much death benefit. How much of it now do you want to convert to whole life, make it permanent, and act that as part of the strategy, especially going into retirement?
Oh, absolutely. Absolutely. And especially if you can't get more coverage, might as well get something of that and be able to keep the tax code advantages that life insurance has.
Yeah, and that's kind of what I brought up a couple weeks ago too, where that's kind of the point of getting a life insurance policy in place while you're young. And even if maybe you don't necessarily need something right now, you may in the future, or you don't think you do, and you may become uninsurable.
Mm-hmm.
And it can always be converted at any point, as long as there's a convertibility option in the policy, you can always be converted at any point within that term, at least part of it, to a whole life policy. So that way you have something in place for the rest of your life. And
what's considered young now? Because remember the type of planning we do, the sweet spot of the age with using life insurance for cash flow and using the collateral capacity of it, 55 to 65, 57, 67, somewhere in that 10. Is that young? Or you look at when I started in the business, life expectancy was early 70s. Guess what? If you're in your early 60s and you come in to do tax planning, you're looking at a shorter leash. Now we're looking at you're in your 60s and you're planning for 30, 35, 40 years. What's young anymore? I mean, when we took it, almost everything we look at now is long-term planning, unless if you're dealing with somebody that's over 83 or 85 and can't get life insurance anymore because of age, or the government has regulated what they can and cannot invest in because of suitability requirements. Yeah. We are in a whole new world right now when you take a look at age and life expectancy, and to make sure our planning is so good that somebody's not going to outlive their money, which is the number one concern for single females.
And especially with life expectancy getting longer.
Mm-hmm.
For both males and females, right? So
yeah.
But at the same time, there's a different focus depending on our age, because the younger we are, if we're even financially attuned, we're thinking, how much money can we accumulate? Doesn't matter where. They're just thinking we just need some. It's not until we get into those older ages, like, okay, retirement's just around the corner. How is all this other stuff going to affect it? Which is why these conversations tend to be more effective. The older one is just because it's closer to them, to their reality, as opposed to let's just accumulate as much money as possible. Give me a whole bunch of crypto, and let's just ride that train. So it just depends on the mentality of the person that is looking at making those long-term decisions. And typically, the older they are, the more tax sensitive they're going to be, as well as longevity sensitive.
Here, my last three are more along the lines of you just can't set it and forget it. What were your financial goals at the beginning of the year? Review them, see what you've achieved, and see what they need to change to for 2025. Important. Remember, goals give you direction. Not necessarily you're going to hit the bullseye, but at least it puts you in the direction. Number 4, have your expenses changed to where you need to adjust the amount set aside for your rainy day fund? And here's how I like to show people this. You know those beautiful fountains that have like the small fountain on top, the medium fountain in the middle, then the very large fountain at the very bottom, and it fills up and flows over all the way down.
So we're talking about the fountain at the beginning of Married with Children.
Yes, exactly, in downtown Chicago.
There we
The
go. Yep.
Buckingham Fountain.
So the very top is your everyday money. That's what you keep in your general checking account. It's going to have probably 1 to 2 months of your normal living expenses. When you've got that done, it overflows and starts filling up your emergency fund. That's 4 to 6 months worth of expenses. When that fills up, it flows down, and then that's where you really get into, putting away money and looking at retirement planning or saving for a house or saving for your next car or whatever you're doing, college education. That's where all the big planning goes. Remember, those are not static. Those change as your income changes. So take a look at those and go, okay, if my income is a lot more, I need to have more in my middle bucket, my emergency fund. That fountain got bigger. I went down to the Home Depot at the year-end Black Friday sale, and I got myself a bigger fountain for that middle one because I make more money now. You're going to have a bigger one for the bottom too. Hopefully you bought them at the same time and saved the money. That would give you more money to put in the bottom fountain. So these things change. You need to make sure that you look at them annually as well. And this is one that is very important. It doesn't affect my clients much because of the type of planning I do. But if you are somebody that has a lot in either mutual funds or stocks, every year you should sit down and have your risk assessment done to see if it's changed. In 2008, Kurt probably could attest to this as much as I can. When all of a sudden you had clients that had never really lost much money at all in the market. And if you had money in equities or mutual funds, and all of a sudden across the board, they lost about 48%. It's funny, on the first question of the questionnaire that I had on the risk assessment, if you lost 20% of your investment, would you be concerned? And it'd be funny because I'd hand this to a prospect or a husband and wife or whatever, and I could tell when they would snicker when they would get to certain questions, and that was the one that would usually be a question. I wouldn't worry about 20%. It's no big deal, Market always comes back, and what's 20%? Well, when it happened, and your 401k went to a 201k, guess what? That became a real concern. And I think right now, at least, we have a across the board group of investors that have at least experienced one market correction. Maybe some not a major one, but at least they've got enough to have some experience to be able to fill out the risk tolerance questionnaire and feel like that they have real experience to measure those questions to get a good, accurate reading. Those are important to look at to see if you do need to make changes in your portfolio to not be surprised.
Yeah, some of those questions really need more clarity on there, because now it's not just if you lost 20%, it'd be like if you lost 20% in a week or in a month, because 2008 happened in 2 months. I mean, the market went through a free fall from September to November. So that freaked everybody out. No one was predicting that to ever happen. Whereas we look at the .com thing from 2000 to 02, that was ebb and flow for over weeks. Sometimes it would go up, then it would go back down, go back up, and you just didn't know. So it was a more tame loss situation. You just weren't sure what was going to happen. So being able to put in a time frame, and then also the sequence of returns risk. If the market went down the day before you had planned to retire, what would that do to your retirement plans? If the market went down that 25%, now you got 25% less and you're retiring now. Now, what does that mean?
Yeah.
So there's a lot more things with that context. We can actually look at some of those risk assessment questionnaires and realize people overestimated their risk assessment because of the way the questions were asked. Unfortunately, that's partly the industry's fault. Just because of how some of those questions were asked at the time. And at the time, I would have laughed at them too. It'd be like, nah, that would have been fine. No problem. Now we have far more context and more math and to be able to bring to the situation. And some people, they don't want any loss, and we're perfect for that. But
and I want to go back to a question that Kurt asked, because Kurt asked, he asked an incredible question, and that was in regards to retirement planning for individuals in taxes in transition years. And I mentioned that, transition years would be, when you get married, when your kids reach age 17 or they're no longer in school. Retirement is a big one. You lose a spouse. Those are all big planning things. But retirement's probably the biggest one. And I'll give you some real life examples on this and why it's important. Generally, most of my clients, when they hit 60, I'll usually just ask the question, what's your exit strategy? Normally, that's all I have to say, and they'll just open up and say, here's what I'm thinking. These are the years I'm thinking about. I'm thinking maybe, 68 or maybe 62, or, my parents died young. I'm going to start taking a 62 on to make sure I get it, whatever it is. But you have a lot of things to look at. One, you have, when do you start collecting Social Security and how that's going to affect your taxes? If you draw it at 62, what's your income look like? Do you know that you have to pay it back if you reach a certain threshold? Does it make sense? Does it not make sense? How are you planning this in association with your spouse? Do you have a situation where you have some gap where maybe what you're going to do is you've got a lot of extra money that you make that you don't have a place for? That's where you load up in the qualified plans, get the deduction on it, and then you're going to be pulling it out over the next couple years before you start Social Security. So now you created that gap with real tax savings as far as using the qualified plans to go against the IRS as opposed to benefiting the IRS. Let's say you're single. You've got a large house that's completely paid off and interest rates are still at 3%. You got no kids. What do you care if your house is paid off for? You're never going to enjoy the benefit of the cash that's in there. There's not a room inside the house that has the cash of the equity that's in there. Why not get a loan on your house? It fits inside what your guaranteed income is for the rest of your life, and take all the cash out now while you can qualify for a mortgage. Use the money. Who are you going to leave the house to anyways? Just to sell it and have the money go to some charity? There are so many different ways to plan for retirement in the years leading up to, in the transition, in the retirement years, that there is no one right answer or way to look at it. It literally is a case-by-case basis. And hopefully you have found somebody with a lot of gray hair that's been around the block a few times that can go, not a big deal. It's the same thing with a pilot. I mean, if all of a sudden, you've got turbulence all over the place and you got the pilot that comes on there and says, hey, we're experiencing some really bad turbulence. I'm really scared here. I hope your will is up to date and you're prepared to die and ready to meet your maker, because this is bad. If that happens, you're not going to feel too good back in coach. You're not even going to feel good in first class, but at least you're getting free drinks. But if the captain comes on and says, hey, we've got a little turbulence going on here, it's no big deal. It's going to last 17 minutes and 32 seconds, and we've got this under control. We're already talking to the flight deck, and we know that all we have to do is go up about 600 feet. We'll lessen it for you. Just kind of strap that seatbelt down a little bit more so that we don't have no problems, and then we'll kick back up with the drink and beverage service here in about 15 minutes. Enjoy your flight. Thanks for flying with whatever air. You're going to be like, oh, that's cool. I can handle this.
I guarantee you that was not Spirit Airlines. Anyway.
And it's the same way with financial advisors. If you've got advisors that have dealt with so many different types of situations, it's like, oh yeah, we've done this for other clients. We can easily do this for you. Here's how it works. Here's how we do it. Here's all the mechanics of it. And this is what it looks like. Does this look like the numbers work for you? Yeah, that's great. We just solved your problem.
And even better, if we can take advantage of some of these things that happen because of how we properly position somebody, that much the better that the client could be better off.
And that doesn't start the year before you're ready to retire. That should be 5 to 10 years before, and allow you to have everything in place and transition to where you've got a smooth transition, as opposed to we got turbulence. How are we going to get this thing, back to calmer air?
Yeah, the more time we have, the more lead time we've got, the better the planning can be, the more smooth that transition can all be, and it's more anticipated, because we've had more time for it. So I got one last question here for you, Brian, which is slightly off topic, but not entirely. For business owners, can it make sense to change their legal entities, from a sole proprietor to partnership? Obviously, that's obviously if you bring on a partner, or to a LLC, an S corp, a C corp. Are there certain things to look for? I mean, to me, I'm thinking of if you're bringing on employees, that's a good reason to get an entity established because it protects your personal assets from being sued by your employees. If you're in the insurance business and you're recruiting people, that's another thing. It can protect your assets from the acts of other people in your downline. But I was just wondering if there's anything else, whether not just from a tax perspective, but when does it make sense to look at other business entities as you're growing a business?
I know Mike and I, we've actually showed this to clients in a few different. He's seen my entity explanation, and I think Kurt, you've seen it too. I think I showed it to you in a hotel room in Nashville after one of our meetings. And when you think about all the different entities out there, there's two things to look at. One is there a tax advantage or is there a legal protection advantage? And those are all on a case-by-case basis. And usually the tax advantage one is to go from either a sole proprietor or an LLC to an S corp. And if your income gets above a certain limit, let's just say for sake of discussion, your bottom line net profit in a sole proprietorship or a single person LLC, which is a disregarded entity for tax purposes, is let's say above 70,000. It would be worth having the conversation of seeing how much money you could save, or if you could save money by transitioning to an S corp. And the answer is yes. This would be the exact time of year to do it, because S corps, LLCs, sole proprietorships are all calendar year type of entities. So January 1st to December 31st, and it's always easier to start January 1st. You can start those at other times, but it's a lot easier if you do it at the beginning of the year. And if you have employees, a whole lot easier to do it at the beginning of the year. So yes.
All right, excellent. I don't have anything else. Gentlemen, do you? We're at the top of the hour here, which is pretty good for us here.
No, I think good information all the way around. Good information, good topic. Always good to have an expert in a particular field to handle questions that that we can pass on to the client and give them as much direction as we can without complicating things.
I did joke a couple of weeks ago that we should change the name of the podcast to the It Depends podcast. Because it depends. The question is, what would our logo be? And I just don't want the logo to have any wings. But anyway,
oh geez.
Sorry. But the thing is that, everything depends. So, when you have questions on these things, reach out to us. And if we don't or can't answer that question, we probably know who can. That's one of the advantages that we have for being a part of networks like this. So, Brian, thank you so much for being on. Great topics, great stuff. And I'm looking forward to seeing how this goes on, because our last podcast with you, it took up its own legs on its own. So it just took off and all kinds of people saw your stuff. So who knows what's going to happen now? Probably if we get the OnlyFans stuff into headlines, we're going to have some fun with that going viral. All right, everybody. We'll catch you all next time. This is the end of the year, so we might not come back on until January. So in that case, happy holidays, Merry Christmas, and happy Kwanzaa, and happy Hanukkah. So we'll leave it at that. Thanks for watching and listening. And by the way, make sure you subscribe to our podcast everywhere that podcasts are. Spotify. Where else are we at? Apple Podcasts, iHeartRadio Podcasts, Audible, Amazon, whatever. You'll find us. All right. We'll catch you all next time. Thanks so much. You have been listening to an episode of the Financial Advocacy Podcast. As a reminder, you can't hold us accountable for any actions you take on your own. Just like all financial entertainment shows, we are not providing legal, tax, or securities investment advice of any kind. We do provide general investment information for educational purposes only, and we will discuss alternative financial strategies that do not contain accrued securities. You can view all of our disclosures and disclaimers at our website at www.financialadvocacypodcast.com. Look both ways for across the street. Thank you for listening, and make it a great day.